Good morning. What lenders actually look at, and it's not what you think. Many borrowers assume mortgage approval comes down to three simple numbers: credit score, income, and interest rate. But that's not actually how lenders make their decisions, is the point. And behind every loan approval is a much deeper evaluation of risk, structure, and financial stability. And in fact, many strong borrowers can get denied, usually not because of their credit, because their financial story doesn't fit the lender's model, is the point. And understanding what lenders truly analyze can dramatically improve your chances of approval. So let's break down the factors that really matter. We'll start with the biggest myth. Credit score is everything. And your credit score does matter, very important, but it's not the deciding factor that most borrowers believe it is. And lenders use credit scores primarily as risk indicators and not as a final approval trigger. So let's give you an example. Say a borrower, you, has a 780 credit score, but unstable income and may struggle to qualify. However, as compared to a borrower with, say, a 690 credit score, but a strong cash flow and reserves in the bank, those will get approved easily. And the real questions lenders ask is, does this borrower demonstrate financial stability and repayment capacity? Am I going to get my money back if I lend them? Factor number one, your debt to income ratio. And one of the first things lenders evaluate is debt to income ratio, or DTI. And what that metric does is it compares your monthly debt obligations divided by your gross monthly income. And most traditional mortgage guidelines will target, say, 36 to 43% of your total DTI as for conventional loans, up to 50% in some cases with strong compensating factors. But it's not just the percentage that matters. Lenders also analyze the debt structure, which can include, personal auto loans, student loans, credit cards, personal loans, and any existing mortgage is. And strategically, restructuring debt can often make the difference between an approval and a denial. And that's why working with a broker matters. Factor number two is income stability. Lenders are far more concerned with income consistency than income size. So they'll ask questions like, is this borrower W-2'd or self-employed? How long have they been in the same industry? Is the income stable or is it seasonal? And for self-employed borrowers, lenders often analyze, say, 2 years of tax returns to get a good income snapshot, but also your profit trends and your business stability. And this is why bank statement loans and non-QM programs have become increasingly popular. And they evaluate actual cash flow instead of tax return income. So factor number three is cash reserves. And one factor many borrowers can underestimate is the liquidity that you need. And lenders want to see borrowers that have financial reserves available after closing so they're not stretched too far. So some typical reserve expectations can include, say, 2 to 6 months of mortgage payments for primary homes, or 6 to 12 months for investment properties. And what reserves demonstrate is financial resilience, which ends up lowering your risk for the lender. Factor number four is loan structure. So smart borrowers know something important. Structure beats rate every time. And a loan with a slightly higher rate but a stronger structure can be easier for a lender to approve. And we want your loans approved. So lenders will analyze your loan to value, the property cash flow for investment properties, but also your collateral strength and your exit strategy. And for investors, lenders often prioritize debt service coverage ratio, or DSCR, rather than the personal income. So factor number five is the borrower's overall financial story. And underwriters aren't just reviewing numbers, they're evaluating the entire financial narrative. And they're going to want to understand how the property fits into the borrower's portfolio, the borrower's experience, Do they have a risk management strategy? And do they have long-term repayment capacity? And this is where a mortgage broker like myself can add significant value to you as a customer. Instead of submitting a loan blindly, brokers will structure the file so it fits the lender's risk model. And when it hits their desk, boom, approvals happen. So let's talk about why many good borrowers still get denied. And most denials happen for one of three reasons. One is poor deal structure, two is inconsistent documentation, and three is submitting the loan to the wrong lender. And with over 600 plus lending sources available today, this is rarely just one solution for us. And the key really is matching the right borrower to the right lender. So let's have a takeaway summary for today. Mortgage approval is not about finding the lowest interest rate always, but it is about structuring a deal that's going to fit the underwriting guidelines and demonstrates the stability of your client. So the borrowers who succeed understand that lenders evaluate a number of factors, including cash flow, stability, your liquidity, the structure of the deal, and your risk management. And when all of those elements align, approvals become significantly easier. Now, if you're planning to buy, to refinance, or to invest in real estate, structuring the loan correctly from the beginning can save you time, save you money, and save you frustration. And that's what I am here for. My name is Bill Rapp. I do mortgage and capital advisory. You can visit my website at billrapponline.com. Figure out how to get a hold of me and love to talk to you more about your situation. Have a good day.